Let's get a move on then and put the spotlight on what exactly the US election impact could mean for the overall global economy, what it could play out as well in terms of a very tight race for the Indian markets as well. And we've got Chidu Narayanan, head of macro strategy APAC at Wells Fargo, now joining in on the show. Thanks so much for taking time out. And of course, all of the reports seem to indicate that it's a neck-to-neck race that we're seeing between Donald Trump and Kamala Harris. Just to give us a sense as to what exactly the impact could be if, in terms of what the overall US macro picture is looking like.
Hi, good morning, and thanks for having me. You're absolutely right. It looks like it's a neck and neck race. National polls in the US suggest the margins less than 0.5%, and that typically the margin of error is usually around 3%. So there is a very, very close race that we are anticipating. Markets have moved one way and the other. Leading up to the election, there has been this Trump trade that has been put on, but we have seen a bit of an unwind of that over the last 3 to 4 days. The two most likely outcomes are either a Republican sweep of the Senate, the House, and the White House, or a split Congress with a Kamala Harris victory in the presidential race. And these two have very different impacts for both FX and rates. Very simply put, in the former, we could see a much stronger dollar and a much softer dollar in the latter. Two specific points that would drive markets would be potential tariff risks on a Republican sweep, potential increased fiscal issuances on a Republican sweep, and higher risk premia on both FX and rates.
What is your view on what will happen to the Fed's balance sheet? Because that, in a sense, would be the single most important factor which would decide which way the money printing factor would move. Do you think, irrespective of who the US president is, they are likely to follow loose monetary policy?
Yes, we have the FOMC this week as well. And the Fed would want to be very apolitical, not just be very apolitical, but also signal that they are very apolitical. We and markets are expecting that they cut policy rates by another 25 basis points at this policy meeting. We expect further rate cuts from the Fed. And particularly important for the Fed would be more domestic economics rather than politics, and how the latter affects domestic economics. More recently, we've seen that growth has been picking up slightly better in the US, chugging at a slightly better rate. The labor market is much less concerning than they had expected that it might be back in July and August. And that will enable the Fed to be easing at a slightly more measured pace. We think that the Fed will continue to ease if labor market weakness persists, especially if the disinflation outlook continues. And fiscal policy would drive how much of the disinflation outlook continues in the near term, and that is where the impact of the US elections on monetary policy will be.
Let's also look at what the realistic setup is. The realistic setup of the world is that nobody can afford tariffs. It is widely anticipated that the Republican regime, if Donald Trump is the president, could really raise entry barriers and tariff barriers. But that attempt was done when the world was in a very different state, so to speak. Right now, the world is in a very different kind of shape and stage. So, do you think, unlike market expectations, there may not be a tariff war even if Donald Trump becomes the president?
That's an important question. And see, let's just make it clear. One, we did have increase in tariffs from the last Trump presidency, but those tariffs have not gone away. In fact, they've been increased under the Biden presidency. And there are still tariffs on imports into the US, particularly from imports from China. And we'll also have to differentiate, if there is a Trump victory and a Trump presidency, on what market impact would be and what actual policy implementation would be. Because the election result would probably be out this week, but the president does not take on board till early January, and policy implementation with respect to, say, tariffs does not come on at least until early Q2. So there will be a difference between what markets anticipate this week and next on a Trump presidency and what will actually happen. And there will have to be some probability that you assign to maybe a 60% import tariffs from China and 10% to the rest of the world. Whether it happens or not is immaterial to what market action would be. We think that in that scenario, the dollar could be up by probably another 4 to 5% from current levels. And treasury yields could also be up quite substantially from here.
I'll go back to that entire China factor. If tariffs are to be increased, do you think that China would be again the sole target, or the tariff increase could also apply to countries like India, which also are big trading partners to India, to US?
Right. So what has been spoken about so far, what has been suggested is at the extreme level, 60% import tariffs on imports from China, but also 10% import tariffs from imports from the rest of the world, which includes India as well as allies such as the Euro area. And what impact that would have on markets is, one, the dollar is going to be substantially stronger because increased tariffs means significant increase in inflation and significant increase in risk premium. And in a risk-off scenario, the dollar will perform. Second, emerging market currencies will get hit quite substantially, particularly the ones that are being targeted. So in that scenario, the likes of China and CNH would be hit quite significantly. We could see pick up in dollar CNH maybe all the way to 7.4. It's trading below 7.1 at this point in time. And third, you would have the likes of the INR actually being slightly outperforming the rest of the world. So dollar INR would be higher because the dollar will be stronger, but the impact on INR given the trade to GDP for India is much lower than the trade dependence of some of the other emerging markets, and India being a bit of a risk-off currency within the emerging market framework could be an outperformer. So the depreciation that the INR could face in such a scenario would likely be much lower than what you could see, say, in CNH or in other parts of Asia or emerging markets.
Put some data point on the screen and which really captures that how US markets, Nasdaq, S&P and Dow have moved a month after the election. And whatever may be the outcome, was the Democrats last time, it was Republicans before that, then it was Barack Obama for 2 terms. Markets a month after the US election, irrespective of the party or the president or the policy or the rhetoric or the underlying levels, they tend to go higher. So can I say that whatever we've discussed right now, it's all right, it is all correct, but like you said, that there's a difference in policy making and there's a difference in market positioning.
Yes, I'm not an equity expert, so I'll reserve my comments a little bit on the equity markets. But for the equities, the Senate race would be very important, arguably more important than what happens in the White House, given US equity markets would be driven more by domestic policy. FX markets would be driven more by external policy and foreign policy and how that impacts all cross-border flows. But yes, we will have to differentiate between market reaction and actual policy action. Policy action, like we discussed earlier, could be as late as maybe late next year on the fiscal policy front and early Q2 on the tariff front. But market reaction is going to be this week and in anticipation of potential policy changes. One thing we could say with a little bit of certainty is irrespective of who comes on board, there will be increased market volatility over the next 3 to 4 days through to the end of the week. There is also another risk that given that it is expected to be such a close election, results might be delayed more than it might be otherwise. So we could have an uncertainty premium that is impacting markets through to the rest of the week as well.
Thank you so much for joining in.